micro-lending in Nigeria is on the rise. The number of people trying to make ends meet are, bridging the gap between whenever they get paid or if they're self-employed, whenever their next revenue stream comes in by getting payday loans, short-term loans, basically micro-lending in order to stay afloat. Now, with where things are, with fuel subsidies being removed, this latest hike, of course, that's going to squeeze the cost of living, or rather squeeze the disposable income for the average Nigerian. What does that mean for micro-lending? Who better to discuss this with us than Onyinye Okonji? She's the co-founder, chief commercial officer of Sycamore, which is, of course, a player in the micro-lending space. You're very welcome. Good morning to you. Thanks for joining us.
Thanks for having me.
So, you've seen what's going on. How would you describe the micro-lending space as of right now with where things are, just people's incomes being constricted?
Yes. Okay, so things have happened in the economy to affect this constriction, right? We have things around first we have the diesel subsidy removal that increased significantly the cost of production in Nigeria. So you talk about the cost of producing even bread, right? You talk about FX and the recent floating of the Naira. That has increased the cost of importation significantly, right? You have the recent fuel subsidy removal as well. It has increased living generally. You have cost of transportation increased. You have cost of feeding increased. Everything has gone up. So lending too has gone up in this instance because people have to sort of subsidize their own livelihoods, right? Salaries haven't increased with the same energy that, costs have increased. So lending is definitely on the rise. So
explain. So what do you guys do? You are one of those players. That's what you do. You extend loans, yeah?
Yes.
Well, so what are your interest rates like? We have to ask that question.
Interest starts from 3%, but we base it on we massage upwards based on risk profile of the individuals.
That's monthly?
Monthly, yes.
Good Lord. So 3 times 12 in a year.
Minimum.
36% year.
Minimum.
My goodness. That is. How do you screen the people that you get these loans?
Okay, so we have different stages, right? I'll walk you through. Pre-qualification would include us checking local, if you're within the cities that we offer in, checking the age. We need to know that you're not a retiree or a teenager, right? Sweet spot. And then checking that you have a verifiable source of income, right? These are things that we check very quickly. We also want to check capacity. So we check a bank statement. We look for keywords. Those are things that we check. We'll also refer to your credit history. The principle here is that the past is predicted by the future is predicted by the past.
Yeah.
So we'll check your credit history. If it's good, great. If it's questionable, we'll send you back to sort it out. If it's bad, automatically that's a no.
What's your rejection rates? Have they been climbing?
Well, it hasn't been climbing per se because we have been evolving our credit qualification criteria.
Yeah.
So before you even enter the funnel, you are disqualified.
Okay, but the way this works is you make a spread, right? So you're getting funding from, how does it work? Explain the business model further, because you're lending from someone else or something, and then at the rate, and then now turn it around and charge a higher rate. Okay, so how does that work?
So Sycamore is in the middle of Peter and Paul, the pairs, right? We are a financial services company. We create financial services for individuals and businesses in Nigeria via the online platform, mobile app, all of that.
Yeah.
Now, the way we work is that it's a peer-to-peer lending platform. We take from Peter, we lend to Paul, and then we revert back to Peter with the interest.
So you're paying Peter an interest rate?
Yes, we are, definitely.
Okay.
And then we make a margin in between.
That.
Yeah.
What default rates? If we're looking at where things are now, where things are a lot tougher, people. So, are you expecting default rates? That is, people not paying back their loans to go up.
That's an inherent risk in the business, right? That people would not want to pay back. But those numbers go up. But what we've done is we've evolved our risk criteria to accommodate the market realities that we're seeing today.
Yeah, and one of those market realities is inflation, right? Inflation is pushing stuff up, 22.79. The president says he wants lower interest rates for lending. What would that do to your business model if interest rates were to go down?
That'd be welcome.
You would welcome it?
Yes, we'll welcome it because we'll pass the cost savings potentially to the customers. They'll be able to lend at lower amounts, and it welcomes new players into the market.
Yeah.
So
back to the Peter and Paul example.
Yeah.
What was liquidity like before the elections, earlier in the year?
So earlier in the year, there was a lot of uncertainty in the economy, right? People were uncertain about where to put their money, or even if they need to put their money out there because there was a cash crunch, people weren't accessing money. So for us, supply was a little slow, but it picked up after the elections because things eased off just a little after, and then we're able to lend to borrowers.
Is there, as part of the screening process, do you ask what they're going to use the funds for? Do you have like an idea of what the funds are used for?
Yes.
Is it just to stay alive or what?
So we do ask, and most of these are now for survival, really. Prior to now, it was for aspirational reasons. You had people who were borrowing to contribute to their equity for a house, to get a car, things like that. Now it's literally to just fund their lifestyle, pay for rent, pay school fees, things like that. So it has reduced to a survival thing.
Okay, I do want to ask you about the gender breakdown, and maybe how this feeds into the screening process. Are you lending money to? Are more men borrowing? I mean, maybe this comes down to who the chief bread maker is in a home.
Yes.
Yeah, but what's the gender breakdown like?
So more men, only because more men are entering the funnel. More men are applying for loans, so there are more men qualifying for loans, and that's a bigger symptom of the problem where women respectfully exempt themselves before they're pre-qualified for a loan.
Okay.
Right? So you'd see this symptom as playing out in where you see in financial institutions, there are gender desks. You have it in WEMA, you have it in all the big institutions, and even in VCs. There are current VCs that are focused on...
For the sake of our viewers, VCs is venture
capital.
Venture capital. All right, keep going.
Yes,
yeah.
venture
All right,
capitals.
all right.
There are venture capitals such as First Check who are focused on female-led businesses to give them their first check because technically there are more men in the...
Okay, so what about you guys? Can you afford to focus only on lending to women, or you can't? That doesn't fit in with the model. Or
we can't focus on lending only to women.
Yeah.
We can only encourage more women to come out and lend.
Okay. Well, okay. So why are they disqualifying themselves before this pre-screening even starts? What is the problem here? Because this feeds into SMEs and how I remember the Akiume Additional, president of the African Development Bank.
Yeah.
He came to Nigeria, announced something in one of the tier 1 banks, and he said the gap, the funding gap is about $42 billion between male and female lenders. So what's the issue here?
So women are relying more on their communities and their families to be able to get monies out, right? So more men are the ones that are breadwinners. They're focusing on, okay, how do I increase the business? How do I extend working capital in the business to get more cash flow for my family? So if you think about it like that, more men will be bolder to reach out to institutions to get the funds, while women would, But we're looking at, hopefully, more representation so that more women are engaging. And that's...
So by that regard, simple math, if you have more men borrowing than women, then more men default. Than women, right?
Yes, absolutely. It's just a mathematical thing.
Okay, so look, so with where things are as we look forward now, we've been calculating what the actual pump price of fuel should be, saying that it's possibly still very low. Market forces things might get tougher in the short term. So as you sit with your strategy team and look at the lending pipeline, what do you foresee? If there's more difficulty, does that mean you will get more applications for small loans?
Absolutely.
Yeah.
More people, because the disposable income of people have reduced, salaries are not increasing with the same energy. So therefore, people will definitely ask for more microloans to fund their lifestyle.
So this is my thing, right?
Yeah.
If we know that the economy is getting tougher, and there will be more applications for loans, but the ability to pay is now reduced because the economy is tougher, does that not mean that you are anticipating a higher level of default?
I said earlier that we are accommodating the market realities.
Okay.
So if we see that, at this income level, more people are defaulting, we are going to shift to a higher income level. Unfortunately, this excludes some of the income brackets, but that's the...
You see, and there you have it. So that means when you move to income, primarily, a source of income has to be one of the criteria that you use in lending. So that most of these people already have jobs.
Yes, they do.
So what about self-employed? Do you?
Yes, we lend to self-employed people.
What's the percentage of self-employed versus people who are in corporate Nigeria who already have jobs? Like, you know.
In our business?
Yeah.
It's more businesses. It's more small businesses that lend from us.
Aha.
The reason why is because
they have a source of revenue coming in.
Exactly.
You see, so how do we get? I don't know. So the whole. Okay, what's your take on financial inclusion with where things are now? Because it's people in the rural areas that don't really have the jobs. I mean, it's okay, no need to break things down too much. Are you optimistic that we can improve financial inclusion in Nigeria? Let me put it that way.
In the short term, it's difficult to say because we're talking about excluding some income brackets already.
Right. Because
of the disposable income that they have. So in the short term, that's going to be difficult to say. But in medium to long term, we'll just remain hopeful.
And are women not part of that financial inclusion conversation? If we're trying to extend that, is it not more? You need to get more women essentially to be in that financial inclusion pool.
Yes, we do. And there are several apps and businesses that focus on just women, getting them in the pool, getting them. There's Harvest, Her Economy. There are other gender desks in financial institutions that do this. So yes, definitely.
All right, what about building credit? To reward somebody, we've talked so much about defaults. I don't know if
it's a major thing.
Let's be more positive now. For people who pay back their loans on a regular basis, does their credit profile in terms of how much you can borrow in the future, does that go up?
It does.
You paused there.
I paused because what it does primarily is it pre-qualifies you to take another loan.
Right.
But if your income doesn't increase...
Wow. You see, and that's a problem. That is a problem because in the West, maybe I shouldn't be using the West, maybe in South Africa. I mean, if you pay back a loan and you're consistent, you borrow... what's the range? From like 40,000
100 to 6 million.
In the millions, fine. So you borrow 50,000 today in January, you paid it back in... Oh, by the way, how long is your tenure to pay back?
9 months first cycle.
Yeah, and then it can go on maybe a year?
It can go up, yes.
Fine. You borrowed 50,000, you paid it back in 3 months. You came back, hey, Sycamore, can I get 80,000 this time? I paid it back. No, sorry, you won't give me 80,000, right? You paid 50,000. You borrowed 50,000 and paid it back.
Yes.
So if I come back again
for a longer tenure, I can give you more.
So you can give me the 80,000.
Yes.
Okay.
But when you've maxed out to the maximum tenure we have, which is 15 months at the moment.
Yeah.
Your capacity cannot go beyond. There's a debt to income ratio that we have to check.
Hey, we talk about that number a lot. Debt to income, debt service to revenue for Nigeria. Yes, keep going. Yeah.
So your debt to income ratio is a fixed ratio so depending on the tenure, we can accommodate you. But once it exceeds our maximum tenure, and your income hasn't increased, it limits you.
This is why we invite players like you in the financial services space to talk about these things, because when people throw out these buzzwords, financial inclusion, get more people in the pool, it looks like it is really hard work.
It is.
And our population keeps on growing. We're getting more people that need to find jobs. So there's, of course, obviously an unemployment bent to this. Are you optimistic that any of this can change? We're almost out of time. What do you think needs to happen? Is it that the economy just has to grow? We just have to create more wealth for people?
Well, there needs to be more cash in people's hands, right? And
we're just talking about money supply in our other segments, and you want to put more cash in people's hands. Well, I'm with you.
The truth is, if your capacity remains the same, your access to credit will be limited. Right, with this economy. But so the economy has to really improve for us to be able to relax some of the lending criteria to accommodate people at the bottom of the pyramid.
Is tech a way to get this? How can you talk about the online platforms and how they have driven what you've been doing?
Absolutely.
Yeah.
So some tech right now helps us get to the 9th mile, right? It's we have an app, Sycamore.
Yeah.
Right. All our borrowers go through Sycamore to
And you can track everything that way.
We can track all the information.
Yeah.
We can. That's why we have the breakdown of the gender.
Right.
So you apply through this. There's some fragments of our customers who don't have smartphones, so we accommodate them through USSD. Right. So you can apply for a loan through USSD. And then others that are not very savvy with the mobile, they go on a computer and then apply. So tech really just enables us to reach the customers.
You know, we're going to keep in touch. This is July. Maybe, keep going through as the year to see how the numbers go. It's a very fascinating topic. It's vital to our economy. People need loans. People need credits. And that's, people need cash in their hands. Yeah, exactly.
That's why we're here.
Onyinye Okonji, Chief Commercial Officer, also the co-founder of Sycamore. Thank you so much for a very engaging, informative conversation.
My pleasure.